new technology out there, cryptocurrency. It's a new currency. And we need to figure out how to integrate that into real estate, or not. Because it's coming, it's here, it's arrived, and as scary as it may be, and as all of us might think it's a bunch of hooey, it's here and people are actually using it and making money from it. So how can we take advantage of that for real estate? So without further ado, I'd like to introduce DJ Scruggs.
Hello? Yeah. All right, can you hear me? So this quote up here on the screen, the future is here, it's just not very evenly distributed. This came from a guy named William Gibson. Does anyone here know who William Gibson is? Oh, we got one. He wrote the book Neuromancer. Neuromancer came out, he's written a bunch of books, but Neuromancer came out in 1984, and it basically predicted cyberculture. In fact, the word cyberspace comes from the book Neuromancer. And William Gibson's one of those science fiction writers who just has a really good sense of being able to see the future, not just a couple years out, but 10, 20, 30 years out. And let's see if I can work this thing. If I add 4 words, then I can attribute it to me. So the future of real estate investing is already here. It's just not very evenly distributed. And of course, that's by the great futurist DJ Scruggs, at which point you're probably wondering, who is this guy again? So my background is I did 20 years of tech startups. I started my first software company in 1995. And if you can believe it, this was, the internet was still kind of a nascent technology. My company made software for doing email customer service. And I had to explain to investors why email was going to be important. Most of them didn't believe it. They all thought email is just a toy, it's just this thing, it's on AOL, it's never going to be a significant part of business. And so I had to spend a lot of time just saying, no, this is kind of important. Email is going to be a big deal. Also back in 1995, just to date myself a little bit, I was one of the first 10,000 users of Match.com, which I get a free account for being the first 10,000. So I still have a free account all these years. But back then, you couldn't even upload photos to them because digital cameras weren't really common then. And that's going to be an important point I'm going to make in a little bit. So does anyone here own any Bitcoin? Oh, we got a few. Great, great. So for those of you who don't own Bitcoin, I'm going to show you what it's like to own Bitcoin. It's like this. Sometimes it's like this, though. The last couple of days, it's been like this. And even in a single day, you kind of will get a little bit of this, a little bit of this, a little bit of this. It's definitely a roller coaster ride. It's really, cryptocurrencies are the exact opposite of real estate in almost every way. It's 100% speculative. It's one of those things where no one knows what's really going to happen, and you just throw a little bit of money at it, or don't, and see what happens. And that's kind of how the tech industry in general has been really since the very beginning. It's a land of irrational exuberance, where a lot of money gets thrown at a lot of deals. Most of those deals collapse, but 1% of them do so well that it makes up for all the failures. So it's really the opposite of real estate in that regard. So let's get into some definitions about technology. So Bitcoin is the first cryptocurrency. What most people don't know is that it's based on cryptographic protocols that started as an anti-spam technique for email. It was originally something called hash cache. And I know this because my company worked in the email industry, and this was one of the challenges we had to deal with was spam, as people blasting out email that was irrelevant and often fraudulent. And so hash cache made it, the theory of hash cache was that if my server is sending another server an email, it should have to do some work to do that. It shouldn't be just as easy as sending an email. So there should be a cryptographic puzzle that makes that happen. And you know, if it's just me sending an email to Jillian, what's 4 seconds? But if it's me sending 500 million emails across the country, then that's going to start costing me real money to send it. So that was the basic idea of hash cache, and Bitcoin arose from this notion of using cryptography as a way to create scarcity and to make something expensive that was previously practically free. So what Bitcoin uses is the blockchain. Blockchain is actually a very simple technology, but basically you take something, you encrypt it, and then you take something else and you encrypt that plus what came before it, and you keep adding on and on and on, and it makes it very hard to crack. It makes it pretty much impossible to crack. And then where it becomes even more interesting is when you distribute that across many, many computers. I'll show you an example of that in a moment. Ethereum is kind of like Bitcoin 2.0, as Jillian referred to. So whereas Bitcoin is purely just a currency, Ethereum is really a software development platform. And I'll give some examples of how that works in a little bit. A smart contract. So the idea of a smart contract came from a guy named Nick Szabo. Back in 1994, he wrote a paper about this. And at a really simple level, a smart contract is basically a contractual agreement that is mediated by computers. So a really, really simple example of that would be a vending machine. You put $1 in, you push a button, and something comes out. There was no humans involved. It was all automated. But it's not too hard to imagine more exotic uses of this that could be really impactful. For example, escrow accounts, right? These days we put money to a title company and then they hold the funds until all the contract conditions have been met. Then they release all the funds as appropriate. There's no reason to think that that couldn't all be done by computer in the next 5 to 10 years. And then a token is just another form of currency. A lot of these companies that have popped up in the wake of Bitcoin, there's over 1,000 cryptocurrencies now, by the way. And what they offer are tokens, which is, if you can think of an arcade, you know, a lot of times you don't actually directly put quarters in, you go and you get tokens and you put those in, but they represent money, or at the casino for that matter. You know, chips represent money, but they're not themselves money. And then an ICO. Has anyone here heard of an ICO, what an ICO is? ICO stands for Initial Coin Offering, and there's these companies that have popped up to do their own coins, their own tokens. Most of them, I would say, are borderline fraudulent. There's a few that are kind of interesting, but it's really unproven. But it's become a backdoor way of raising money. And the SEC for a long time, well, not for a long time, for about a year, they just kind of watched the market and didn't pay much attention. Now they are paying attention. And so there's been several ICOs that have been shut down, and I anticipate that's going to continue to be the case. There basically are securities offerings by another name, but companies have tried to claim, no, it's not a security, it's a utility token. It's a security. So this is kind of a famous chart from Gartner Group. Gartner Group is a research firm. Large companies pay them to help them figure out their technology strategy, you know, what database should I use, or you know, what security practices should I follow? And this is something they've identified in the 30 years or so they've been in business, which is, they call it the Gartner hype cycle. There's a technology that arrives, people get really excited about it, it goes to these high inflated expectations, then people realize, well, maybe it's not that good after all. It crashes, becomes the trough of disillusionment, they call it, and then eventually people start applying the technology and you get to a plateau of productivity. And we see this over and over and over and over again with practically every technology. If I had to guess, I would say that Bitcoin and cryptocurrencies in general are at that peak of inflated expectations. The expectations of the technology are well out in front of the actual utility of the technology. But I do think it will make its way through this to that plateau of productivity. Some technologies never make it past that part. Does anyone remember Second Life? I mean, that was hyped. That was a big deal in 2004. And amazingly, they're still around, but it just never got past that. So sometimes technologies just wither on the vine and never go anywhere. So this is the part where I'm going to do a little bit of math on you and talk about cryptography and how this all works. Basically, cryptography relies on something called a hash function. A hash function is something where you take a piece of information, you feed it through this function, and it's a one-way trip to something that is unintelligible. Let me show you an example of that. So here's some text, and I'm going to run it through what's called the SHA 256 encryption algorithm. And what comes out the other side is this 64-character string, unintelligible. And the thing about hash functions is they are one way. There's no way to unencrypt this. So it's not like a decoder ring where you can go backwards. If you get this and only this, you have no idea that it refers to I love CrowdConverge. Now, another interesting thing about hash functions is, can anyone see the difference between these two sentences, I love CrowdConverge? Right? There's an exclamation mark. So one little change appended to the end of it. And here's what happens when you hash it. It's completely different. So there's no way to look at something and say, this is kind of like that. Hash functions really do truly obscure things to where they're unbreakable. And you can do this with even longer sentences. So this is a very well-known phrase from Thomas Jefferson. If I run it through a hash function, it comes out like this. Always comes out to be 64 characters, no matter what. I could put the contents of the Bible or of Wikipedia in, and it would still come out as a 64-character string. Now, what's also interesting about hashes is you can hash the hash. So this string that I have here, this was the hash of the Thomas Jefferson quote. Now I can take that and run that through and create a new hash. And so when you start to do that, when you take a hash and you hash that and then you hash the next one, you create a blockchain. And this is basically all it is. The blockchain is just a connection of hashes. This is from the original Bitcoin white paper. If you go Google Bitcoin white paper, you can find this. And basically you can see here, I've circled the hashes. And basically you have a transaction. There's some signatures involved that are used to generate a new hash. That hash points to the previous hash, and the hash after that points to the previous hash. And what ends up happening when you do this, that by itself is pretty interesting, but what makes Bitcoin so powerful is this is happening on computers all over the world, and they are all perfectly synchronized. And they use that cryptography to stay synchronized. Therefore, if you wanted to hack Bitcoin and change it, you would have to hack literally millions of computers, right? So it's a law of large numbers effect, and that's what makes it so secure. Now, you may have heard of systems being hacked in the past. You know, someone lost $100 million worth of Bitcoin. That wasn't Bitcoin being attacked. That was service providers who had poor security practices in protecting their private keys. They're the ones who got hacked. So it's still vulnerable to phishing and all the other stuff, but the Bitcoin protocol is rock solid as gold in Fort Knox. So that's a little odd. All right, so let's talk a little bit about Ethereum. So there's a lot of things you can do with Ethereum. It's one of those technologies that's hard to get your head around because there's so many possibilities. And that's true also of the internet. In the early days of the internet, we tended to kind of take old world ideas and put them on top of the internet. So trying to explain Facebook to someone in 1989 just wouldn't make sense. Even to someone who was using the internet, because the internet's been around since 1971, it wouldn't have made sense to them. So these new technologies, when they come, oftentimes they allow these incredibly new ways of thinking, and it takes us 10, 15, 20 years even to realize new ways of thinking about them. So I'm just going to go through quickly some of the things Ethereum does. It's a cryptocurrency, a computing infrastructure. It's a transaction platform. It's a decentralized database. It's a distributed account ledger, a development platform, open source software, financial services marketplace, peer-to-peer network, and a trust services layer. Now, I could spend an hour on each one of these topics, and I won't bore you by doing that, but it's pretty clear if you're in real estate or any kind of financial services, this touches on a lot of pieces of the investment infrastructure. And that's why it's so exciting, and that's why there's been so much investment in the technology. Right now, most of the investment you hear around these technologies are for trading. So all the Wall Street guys who like to trade stocks, now they want to trade cryptocurrencies. But that's kind of true of the way we've seen other asset classes in the past, right? So in the early days of the internet, it was all about E-Trade and Schwab and about a million other online brokerages. Companies like Realty Mogul didn't come along until much later, after the infrastructure and habits had baked in a little bit. So what do blockchains in general enable? So the main thing is they make things programmable that weren't programmable before. They are programmable money, they're programmable trust, programmable ownership, programmable identity, and programmable contracts. And as a software guy myself, this stuff gets me really excited, but also I'm still looking for models to help me figure out what I can do with this. You know, in the very early days of the web, no one ever dreamed something like Facebook would come along or Twitter would come along. But someone eventually did. And so we're in this stage now where we know certain things are possible, but we're still not at the stage where we have envisioned truly what's possible. We just have kind of some basic ideas about it. But I'm just going to talk about a couple of examples. So how many of you have seen a form like this? Like when you're signing up, right? This is ubiquitous on the internet, you know, something like this. So the way this all works is it's basically just databases, and these are databases behind firewalls. So if you log in that first case with your username and email, that goes to a database that company that runs that site gets. If you go through Facebook or Google or LinkedIn, you're still going through their databases. They've just exposed a tiny little piece of that database so that other companies can integrate with them. But fundamentally, your information is in their database. Now, those are some pretty well-known providers of identity services. Can anyone else think of some other providers of identity services? Equifax? IRS, yes, exactly. Well, these are the three biggest providers of identity in the world, right? And what do we know about them? They're on databases that are hackable. Like, yeah. I mean, Experian, what was it, 75 million users were hacked? And by the way, when you hear something like that, that's just what you hear about. They're not in the habit of telling people they got hacked, right? The only reason they tell someone they got hacked is if it's a major problem, like in their case, there's going to be identity theft is going to run rampant, or someone caught them. So whenever you hear about, for example, Target got hacked a few years ago, 10 million names and credit cards, Target only revealed that because someone caught them. So for every one that gets caught, you got to think there's probably 5, 10, 20, maybe even 100 who aren't getting caught. And this is a fundamental design flaw of centralized databases. So, do you trust these guys? I don't. So, let's look at an alternative mechanism using identity. So I showed you the image before of these computers all over the world. So when people hear about Bitcoin, a lot of times they think of it as anonymous. Like it's a great way if you want to buy drugs or other illicit stuff. It's not truly anonymous. It's pseudonymous, so it's hard to figure out who's behind a Bitcoin account. But with enough resources, you can figure it out. And people, they tend to think, oh, that's cryptocurrency. That's an anonymous stuff. You know, we deal in real-world investors here who give us money and sign forms, and so that's totally the opposite. But that's not really true. You can use these technologies to guarantee identity. So what I envision happening probably within the next 5 years is we're going to start pulling power away from the Equifaxes of the world and putting it onto blockchains. And then your blockchain is again, it's your identity is shared across millions of computers. Only you can access it because it's encrypted, right? But now you truly control your identity. You're not at the whim of some database somewhere that can be hacked. And this is the kind of thing that right now is mostly excited to sort of the techno-libertarian types. But over time, I do think it's going to catch on because it doesn't just have to be for credit reporting, right? You could have all your credentials in here. Where did you go to school? You can go beyond just saying I went to a certain school. I can prove it and sign that and put that into my identity on the blockchain, which if you're someone who's looking to transact with someone, that's very useful information. You know, not just where they say they went to school, but can they prove where they went to school? That's where identity is going to come in. So another example I want to show is just smart contracts. I mentioned the vending machine earlier. And this is an example of something I do think is going to come in the next 5 years or so. And probably someone like Realty Mogul or IMS is going to be using it, which is how we do distributions. So right now, the way distributions are done, you write a check, you do a wire transfer. That wire transfer costs you from anywhere from $10 to $25, maybe more if it's going overseas. It's slow. It's a pain in the butt. What's going to happen is you're going to have, well, that was interesting. It went out down here, but up here it's still working. So you're going to have a smart contract. You send the money to that smart contract, and then it will handle all the distributions automatically. And so not only is it going to be automatic, it's going to be insanely fast. This whole process can be done in about 10 minutes. And it's automatic, and you don't have to log into anything and do anything. It just happens. And As an example, the other day someone said that they transmitted $400 million worth of Bitcoin in 10 minutes. And you can do that around the globe. That's, by the way, why I think Bitcoin has been going up. There's a lot of people in, let's say, lawless regimes that are looking for ways to get their money out of those regimes, and they're using Bitcoin because it's fantastic for international wire transfers. Here, oh, I'm pushing the wrong button here. Okay, so can anyone tell me what this is? Good one. I'll give you a hint. Does anyone remember CompuServe? Right? CompuServe was the dominant online provider back in the 80s. It was expensive. It was like $3 a minute or something like that to use their service. I think what's interesting about this is they used an old paradigm, right? So when I was a kid, I can still remember my home phone number when I was a kid. Who can remember your home phone number when you were growing up, right? I still remember my first girlfriend's phone number. Back then, you had to learn phone numbers, right? Kids today don't have to do that. You know, that's why I always laugh when I see a TV show where someone says, write down your friend's name and address. I don't know my friend's names and phone numbers and addresses. It's all on my phone. So what CompuServe did, they were following an old paradigm. They went with the paradigm of people are used to dialing phones. We had a dial phone when I was a kid. And so they're going to get used to learning numbers. They're going to learn all their friends' numbers, and that's how they're going to contact them on that service. Their paradigm was there's maybe 5, 10 people whose numbers you'll bother to learn that you communicate with every now and then, and the rest you'll just look up in some kind of a phone book. So the reason I'm bringing this up is, in the 90s, when I was kind of getting into this business, there was a lot of companies that popped up, and at the time, they seemed gigantic. They raised tens of millions of dollars. These companies are the future. They're building all these really cool things, and they're going to own the future. And they're run by very smart people. But the fact is, most of them are gone. I do want to point out one of them, if I can find the ICQ one there in the lower left. Does everyone see ICQ? Does everyone know what that was? That became AOL Instant Messenger. So I signed up for ICQ. I'm an early adopter. I signed up. I was one of their first 100,000 users. And I tracked down and called the founders, because I was working on a technology similar to that. And so I was thinking there might be a partnership opportunity. I called the phone number. Someone answers, hello. And I said, hi, I'm calling for Yasha. It's an Israeli guy. Hold on a second. It was this guy, Yasha, staying at his sister's place in Brooklyn, right? It turned out it was like 2 brothers who started this company. They just wrote it themselves, built it on a whim, spent about 9 months getting it up, and then they sold it. About 2 months after that phone call, they sold to AOL for $280 million. Good times. What was amazing to me is during that time, I was living in Chicago when that happened, and literally a week later, the Hancock Tower sold for $270 million. So these guys in 9 months had created more economic value than John Hancock, the building, had done in 20 years. Now, it was funny money. A lot of times these deals are funny money. I mean, Blue Mountain, for example, does anyone remember Blue Mountain? Yeah, almost no one does. Blue Mountain was sold for $900 million to Excite, the one in the lower right corner. The founder of Blue Mountain is now my congressman in Colorado, Jared Polis. They say once you're lucky, twice you're good. Well, he made that $900 million, then he went off and started a company called ProFlowers, and then he sold that for $450 million. So he's a pretty smart guy. My point in showing this slide is all these companies were gigantic, major players in 1995, 1996, but none of them are left standing except for these guys. This is the original Amazon.com logo, right? At that time, everyone thought they were going to lose because they didn't own Books.com. So my point is, whatever moment you're in when it comes to tech, you have to be very humble at trying to predict what's going to happen. Because the things that seem important now turn out not to be so important. The companies that seem to be competent turn out not to be so competent. And there are big forces at play here that can overwhelm, a well thought out business plan. So here are some companies that are on the hype train for real estate as it applies to the blockchain. I'm not going to spend any time talking about them. Some of them are interesting. I think they all are, have an interesting play, but I also think that this is the 1995 of blockchain, and I think it's probably a 90% chance that all of these companies will be gone within 5 years, because that's just the way tech startups work. But I do want to sort of drive the point home a little bit. Can anyone guess what this is? It's the first digital camera. It was created in 1975. It weighed 8 pounds. And it was created by Eastman Kodak. It was 0.1 megapixel was the size. And Eastman Kodak, they paid this researcher. He built it. He hacked it together. He went and showed it to him. And they said, this is a toy. No one's ever going to use this. This is dumb. We're going to go back to making film, right? Which is what they did. But the interesting thing about this is what's called Moore's Law. Has anyone here ever heard of Moore's Law? Right? It was coined by Gordon Moore, who was one of the founders of Intel. Basically, what he said is the number of transistors that we can put on a chip, a processor, doubles and goes down in price by half every 18 months. So that's a pretty powerful metaphor. But humans, we're not real good at understanding power law distributions. We're used to looking at things linearly, right? So we have a hard time understanding that. And Kodak had a hard time understanding that. You can see here, this is around 1975. They looked at these digital cameras things and said, this is garbage, we're never going to do this. They had a great business, right? Cameras were growing pretty well. And then about 1999, some digital cameras started coming out. And they probably thought, well, it's just a little bit. Cameras are going to go a long way. But by 2005, film cameras were pretty much gone. And what's interesting is not just that it replaced the film technology, it expanded the market tenfold, right? I take way more photos now than I ever would have. And I'm not even that big into selfies and stuff like that. So technology, sometimes it can look like a toy, and it may grind along like a toy, and then one day you wake up and you realize not only is it dominating the market, it's creating new markets that are 10 times bigger than the previous market. So that's why I think cryptocurrencies in general are interesting, and I think that's why we need to watch them. And I think that in 10 years, we're going to be having a very different conversation about this technology.
Thank you, DJ. That was something, huh? We have time for a question or two. Anyone has a question?
Okay. I can't. They control that.
Okay.
Yes.
Here, Robert, you ask the question first, and then I'll get to you.
Could you put the other slide back up, because my email address was on there? Yes.
A couple slides back, you went over the different types of a real estate-related blockchain hype train. Can you kind of just delve into that and some of those products or services that are starting to arrive?
Yes. So this kind of goes to Liz's comment earlier. I think most of these are being created by people who don't really understand real estate. There's a lot of excitement in this industry, what they call tokenization, right? We're going to tokenize assets. You're going to be able to own 1%. Or 2% or 5% of a property, and you're going to be able to buy and sell that. Well, you can do that now, right? There's no supreme benefit to using a cryptocurrency to do that versus going on something like Realty Mogul. They are very focused on, and I think this is because of how they got into this. They bought cryptocurrency, they did well, they think everyone else wants to buy cryptocurrency and do well. And they're thinking about the investors, which is good. Obviously, as a real estate person, you have to think about investors. But there's not a lot of value there, right? At most, you're going to save $25 on a wire transfer. You're going to make it a little bit easier to write a check. But you still got to sign all the documents, right? The cryptocurrency isn't going to fix that. And the distributions still have to be done. And until the infrastructure's there, it's probably going to be done through traditional methods. So I feel like they're all focusing in the wrong place. They're focusing on where there's not really a lot of demand. There's not a lot of investors who are demanding the opportunity to buy real estate with Bitcoin. There's a few that do it just for the same reason that Mark Cuban bought a jet off of eBay. but it's a very small percentage.
Thank you. One last question.
This is more of a comment, or get your input on it. So banks nowadays, Wells Fargo, B of A, have technology which is called Zelly, I don't know how you spell, that basically allows you to transfer money if we all go to dinner and then we split the bill. There's a little bit of a hiccups with that, but the young kids are using that left and right, and I'm wondering if that's an example of where the technology is being used for your smart contracts, that if you see that as that being like the pioneer towards that.
So not yet. There's something called Ripple that a lot of banks are using. They're using it to attack the SWIFT system for international wire transfers. They can save a lot of money. It's a lot faster. But here's the thing. When it comes to technology, so there's the early adopters, there's the late adopters, then there's banks, and then there's governments. Right? The banks are just incredibly slow with this stuff. So they'll probably do some things to make their back office more efficient, but they're not going to give you those 10x returns. I mean, in general, when it comes to technology, ask yourself, if you're looking at any kind of technology, all you got to ask yourself is, will this result in a 10x improvement? Will it make things 10 times easier, or 10 times faster, or 10 times cheaper? If it does that, then it's going to win. If it doesn't, it's not going to win. I mean, Google was 10 times better than Yahoo. They weren't just a little better. They weren't 20% better. They were 10 times better. Amazon was 10 times better than traditional catalogers. So if you're looking at a technology, just ask yourself, is it 10 times better? If it is, then you probably should invest in it.
Thank you, DJ. I appreciate it.